Hello everyone and welcome to my YouTube channel where I teach lessons of economics to students of class 11th and 12th, and this is going to be a continuation on the chapter National Income and Related Aggregates, which is a part of the series Introductory Macroeconomics. You can check out my channel where in the previous videos I've uploaded about basic terms of national income, circular flow of income, basics of national income, value added method. And in this video, we are going to learn more on the value added method. Just a quick recap, there are three methods to calculate national income. The first one is value added or product method. The second one is expenditure method, and the third one is income method. And a quick summary of the value added method, which is available in my last video, that is total sales plus A, that is change in stock, minus Z, that is intermediary goods or raw materials, is equal to gross value added, GVA. And from GVA, when we reduce depreciation or capital consumption, that becomes NVA or net value added. So that was just a summary of what we had discussed in the previous video. We will try to learn more about the value added method by using some practical examples. So first of all, we have a small problem here. There are four industries, namely A, B, C, and D. A buys raw materials of rupees 50,000. A sells rupees 40,000 worth of goods to B. The remaining goods are sold at rupees 20,000. B sells goods to household sector at rupees 60,000. C sells goods of rupees 40,000 to D and goods of rupees 10,000 to private manufacturers. D sells goods worth rupees 50,000 and sells goods worth rupees 20,000 to the government. Calculate the gross value added by A, B, C, and D only. So when we have this particular kind of problem, mathematical problem with us, it is very good to use a particular table. And as you can see on your screen right now, I have simplified the entire formula for all four firms, that is A, B, C, and D, by simply preparing a table where the entire formula is there, that is total sales minus Z is equal to gross value added. Since there is no factor of change in stock or capital letter A in this problem, that is why I have simplified the formula, that is total sales minus Z is equal to gross value added. So looking at this particular information, we will try to solve this entire problem. So first of all, let's go sentence by sentence and try to place the proper amount at the proper table. So the first one is A buys raw materials of rupees 50,000. So this 50,000 is first to be treated. So we will try to put this 50,000 as raw materials, and that is, since raw materials are intermediary goods, it will be coming here in the row of A as minus Z. This has to be reduced from whatever value has been produced by A. A sells rupees 40,000 worth goods to B, which means this is the sales or the value produced as it is in total sales. Very easy to understand, 40,000 is here. But at the same time, we must remember that this is the raw material for B. Since A sold 40,000 worth of goods to B, B will use this raw material and prepare more goods. So this is going to come here as minus Z or minus intermediary goods under the section of B. The remaining goods are sold at rupees 20,000. Now here it is not specified about the fact or to whom has A sold the product, but it is just given sales. And so this 20,000 will be entered here under the section of A. And with that, we complete the first sentence. We'll move to the second sentence. B sells goods to household sector at 60,000. Since we are calculating only the GVA of A, B, C, and D and not anybody else, this household sector will not be included in this particular problem. We are only going to calculate about B. And so you see here B sells goods. So basically this is the 60,000, which is the total sales. Remember, B used 40,000 worth of goods from A and has created 60,000 worth of goods. So with that, we complete this second sentence as well. This third sentence, C sells goods of rupees 40,000 to D. So we'll quickly make this adjustment here. C sells, so which means this is going to be the sales of C. And remember, this is sold to D, and D's intermediary goods will be entered here. We'll continue. And goods of rupees 10,000 to private manufacturers. This is the sales of C once again. So 10,000 once again will be entered here. As we continue, With that, we complete the third sentence. D sells goods worth rupees 50,000. The buyer is not mentioned, so this is going to be the sales of D. And sells goods worth rupees 20,000 to the government. As I told before, government is not going to be used because we are calculating the GVA of only A, B, C, and D. So this is also going to be the sales of D. And with that, we have completed all the information which is presented here in the problem. So all we have to do is now do the mathematical solution, that is total sales minus Z is equal to gross value added. And so as we can see here, we have 40,000 plus 20,000, that is 60,000, minus 50,000 is 10,000. So the GVA of A is 10,000. What about B? We have 60,000 minus 40,000, that is 20,000, that is the GVA of B. Since we have no information about the raw materials used by C, we will leave it blank. And so we have 40,000 plus 10,000, that is 50,000, that is the GVA of C. And then we have 50,000 plus 20,000, that is 70,000, minus 40,000 is equal to 30,000, that is the GVA of D. Now we have to calculate and add all this GVA of A, B, C, and D. So it is 10 plus 20, that is 30. Then we have 80 and then 1,10,000. And so this is going to be the gross value added of A, B, C, and D. Just a quick reminder, the formula is total sales minus raw materials. This is the value added by A, B, C, and D in this particular problem. We'll move forward to another particular problem. We'll quickly read. A purchases goods of rupees 50,000 from X. A sells goods to B for rupees 10,000 and A sells goods to C worth rupees 70,000. B purchased goods from Y for rupees 20,000 and sells some goods to C for 15,000, while the rest is sold to households at rupees 40,000. C purchases goods from Z worth rupees 15,000 and sells to households at rupees 1,70,000. Calculate the GVA of A, B, C, X, Y, and Z. So now this is basically the similar kind of problem as I presented earlier. So if at all you have a pen and paper, you can try to solve and we'll try to see who is faster. So without wasting much time, we'll quickly move to the solution. As we did last time, we are going to do the same this time. We have no change in stock given this, so we will simplify the formula, that is total sales minus Z is equal to GVA. And remember, we have to find the GVA of 6 firms, that is A, B, C, X, Y, and Z. And so I have prepared the entire column here. Okay, so first we have A purchases goods of rupees 50,000 from X. So 50,000 is going to be the raw material because it has been purchased by A from X. So this is going to be the sales of X. Very quickly we finish that. A sells goods to B for rupees 10,000. So this is going to be the second part of information. A has sold 10,000 and it has been sold to B. So this is going to be the raw material of B. And A sells goods to C worth rupees 70,000. This is also going to be the sales of A, but at the same time, it is going to be the raw material of C. So with that, we have finished the first sentence. We'll move to the second sentence. B purchased goods from Y for rupees 20,000. So this is going to be the intermediary goods of B here. But then since Y has sold it to B, this is going to be the sales of Y. Okay, so B and sells some goods to C for rupees 15,000. So this is going to be the sales of B, but at the same time, this is going to be the raw material to C. Okay, and we'll move forward. While the rest is sold to households at rupees 40,000. Once again, we are calculating the GVA not of households, but only of A, B, C, X, Y, and Z. So B has sold 40,000. So this is going to be the sales. And since it is going to be the raw materials of households, we are not including households here. The next sentence, C purchases goods from Z worth rupees 15,000. So this is going to be the purchases of C. So this is another raw material or intermediate goods. But this is going to be the sales of Z. And so we have 15,000 here and sells to household at rupees 1,70,000. So this is the total sales of C. So with that, we have completed all the information that is present in this particular problem. So all we have to do is the simple mathematics. 10 plus 70, that is 80, minus 50,000 is equal to 30,000. This is the GVA of A. 15 plus 40, that is 55,000, minus 30,000, that is 25,000. This is the GVA of B. 1,70,000 And here we have 1 lakh, that is 70 plus 15 plus 15 is 1 lakh. So you have 70,000 as the GVA of C. And then directly you have the 50,000 as the GVA of X, 20,000 as the GVA of Y, and 15,000 as the GVA of Z. So if you sit and add, so you have 30, you have 55, you have 1 lakh 25, 175, 195, 2 lakh and 2 lakh 10,000 as the GVA of ABC, X, Y, and Z. This is how we are supposed to solve the problems whenever it comes to value added method. Just a quick recap, or just to try to explain how we are going to get numerical problems. Right now, whatever we have solved was probably just this first line of the formula, that is total value of output or total sales plus change in stock A minus intermediary goods Z, that is GVA. So now we are just calculating this same value added or product method for the entire formula, for the entire economy. So the formula is going to be as such: total value of output or total sales plus change in stock, that is A, minus Z, intermediary goods, is going to be GDP. Because as I told you, the GVA of the entire economy is called as gross domestic product. From this, when you reduce depreciation or capital consumption because of wear and tear, you get net domestic product. Gross minus depreciation is net. And from net domestic product, when you reduce net indirect taxes, which I'll be explaining soon, you will be getting net domestic product at factor cost. From this, if you add net factor income from abroad, NFIE, you will be getting net national product at factor cost, or NNP at factor cost, or pure national income. So whenever we are using the value added or product method for the entire economy, this is going to be the formula which we are supposed to understand. So now there are so many terms which I have not yet explained. One by one, we will try to understand the parts of the formula. So here we are. The first one is total value of output. So in simple terms, it is the total value of goods and services produced in a country in a given year. In simple terms, it is the total sales of goods and services in an economy in a given year. That is total value of output. The second one is change in stock. I have already explained it in the previous videos, basically about inventory. From the above value, the goods which have not been sold this year have to be added, because they are the closing stock, and this will give an accurate value of this year's output. I've already explained this in the previous videos, basically in the section of inventory. So change in stock is equal to goods produced this year minus sales, which means we will be getting also the closing stock, because that has been created during this year. The value has been created during this year. The next one is intermediary goods. This also has been explained in the previous video, but once again, all raw materials and semi-finished goods will not be included in national income. Therefore, it has to be reduced because they are not valuable. They are not finished products. We are calculating only the total value of finished goods and services produced in a country. That was the first sentence of the formula. The second part of the formula is GDP. After we do total output plus A minus Z, we get gross domestic product. So what is this GDP? It is the total value of goods and services produced by the residents within the boundaries of a nation, after taking into consideration the change in stock and raw materials. So in simple terms, within the boundaries of a country, all those people who are residing in it, whether it can be foreign nationals, Indian citizens, or whatever it may be, all those value created by these people, entire value will be called as GDP. But that is not national income. Remember, GDP is not national income. It is just a part of national income. There are still so many considerations to be taken in care. The next one is depreciation. This also has been explained in the basic terms. All capital goods undergo wear and tear and obsolescence, or being outdated. This reduces their value. Therefore, depreciation is reduced from GDP, and this will give us an accurate value of the goods and services produced. Once we reduce depreciation from GDP, we get something called as net domestic product, and this is the net value of GDP after reducing depreciation. So NDP, or net domestic product, is the GDP but after reducing depreciation. We'll move forward. into the next part. From NDP, we have to reduce net indirect taxes. Now, what is this net indirect taxes? I've given you a hypothetical example. Let us see exactly what it is. Now, imagine if a product costs rupees 10. Its cost includes taxes, inclusive of all taxes. Probably when you read any packaging, you will be seeing this particular statement. Now imagine if it includes a tax of rupees 2, then the original value of the product is only rupees 8. Therefore, indirect taxes have to be reduced. Because originally the value was 10, but the taxes are added by the government and its value has become 10, which means the original value of that particular product is not 10 rupees, it is 8 rupees. Because we have added taxes, it has become 10 rupees. So while we are calculating national income, it is very, very important to remove taxes because they are simply increasing the value. The original value of the product is only rupees 8. In the same way, if the government has provided a subsidy of rupees 5 on a product and sells it at only rupees 15, the actual value of that product is supposed to be rupees 20. Therefore, subsidies have to be added. Once again, whenever the government has provided a subsidy on a product which is worth 15 rupees, it means on behalf of you, the government is paying 5 rupees, which means when you are paying for a particular product, it is 15 rupees and the government is paying 5 rupees. That's why you're getting it at a subsidized value of 15 rupees, which means the original value of that product is rupees 20. And so this is what has to be taken into consideration when we are calculating national income. So in simple terms, the formula for net indirect taxes is minus indirect taxes plus subsidies. That is what we did here. We have to reduce indirect taxes and we have to add subsidies. That will become net indirect taxes. From NDP, when we reduce this net indirect taxes, we get an NDP or net domestic product at factor cost. Listen carefully to this particular point. This is slightly difficult to understand. NDP at factor cost refers to the total value of goods and services produced within the boundaries of a country in a given year after appropriating the taxes and subsidies. This is different from market price. Whenever a product is sold including taxes and without subsidies, that is called as market price. That is NDP at market price, because whenever we purchase goods, we are supposed to pay taxes, and sometimes whenever we purchase gas cylinders, for example, the best example, we are getting subsidies. But now, after we reduce the taxes, as I showed in the previous slide, and after we add the subsidies, we are now not getting the value of that particular product at market price. We are understanding it at factor cost. I'll be explaining this in the next video. We will move forward to the next part of the formula. We have to add net factor income from abroad. Now this appropriation is done to add the income earned by non-resident citizens who belong to the home country but are working abroad. So now many of our relatives who are Indian citizens are working in foreign nations. So even though they are Indian, their income will be added to the GDP of that country where they are working. But finally, they are Indian citizens. That income belongs to India. And so that income will be added to our nation in this particular appropriation, that is net factor income from abroad. Remember, at the same time, in our country, we also have people who are foreign nationals, which means though their income is added to the GDP, it should not be added to NDP, which means that income has to be reduced. The income of foreign nationals has to be reduced from our nation. So it is also used to reduce the income earned by residents who are not citizens of this country. In simple terms, it is denoted as exports minus imports. So all the income earned by non-resident Indian citizens will come under exports, and all the income earned by resident foreign nationals will be considered as imports. We move to the final part of the formula. After doing this appropriation, we get the final product, that is net national product at factor cost. In simple terms, NNP at FC. This is the total value of goods and services produced by citizens of a country in a given year after dealing with all the appropriations which I have explained earlier. It is the purest form of national income, and this is what national income is supposed to be. So a quick recap of the entire formula, that is total value of output plus change in stock minus intermediary goods. When you do that, you get GDP, that is the total value of goods and services produced by all people within the boundaries of a country. It can be Indians, it can be foreigners, and so on. From that, when you reduce the depreciation, you get net domestic product. Now from this, when you minus indirect taxes and plus subsidies, or simply minus net indirect taxes, you get NDP at factor cost. From this, when you add the income of Indians working abroad and reduce the income of foreigners working in India, that is NFIA or net factor income from abroad, you get net national product at factor cost or national income. So this is basically the income of all citizens, whether within the boundaries or outside, because they have earned this income by creating goods and services in an economy in a current year. So with that, we come to the end of this video. Once again, you can check out my channel for the basic terms, for the circular flow of income, for the basics of national income, and for value added method. And in this particular video, I explain a little bit more on value added method. In the next video, stay tuned in my channel where we will try to learn numerical problems and a little more on value added method. Thank you so much for staying tuned till now. If you found this video helpful, please do not forget to like, share and subscribe so that many more students can benefit and revise from it. Thank you so much. Stay educated and stay safe.